Hey everybody, Tom Gentile, welcome. Welcome, come one, come all. This is our very first Optionetics webinar of the year. Glad to have you all here. Yeah, it's me. You can see me on the screen. Uh, Behind me is a sea of red. Besides red, white, and blue, there's a sea of red in here. But I got a really cool graph I'm going to show you guys. So I actually emailed out to you. I'm sure you know this. I guess it was yesterday. A small trading account that I'm doing. I opened a small trading account because, it's been a while since I've actually traded something of smaller size. And I wanted to just kind of show everybody that you can do this in small accounts. Well, tonight, I want to show you my brother-in-law's account because his was even smaller. And he's just been kind of shadowing me for the last month. And I want to show you what he's been doing too. And it all ties into what we're going to talk about over the next 4 weeks. So thank you all for being here. I think you're going to find these next 4 weeks are going to be a lot of fun. One of these weeks, I'm actually going to be in New Zealand, and I'm going to be teaching from my my house out there, which we're closing on. So we got a lot of stuff going on there, but I'm going to take an hour out of my busy schedule going back and forth, getting this house finalized, and I'm going to do a webinar from there because I got to make sure everything works. So we'll talk about that later. Again, thanks everybody for being here and being on time. I'm going to shut the webcam off because more importantly, you're going to see what I have to show you tonight. So here we go. The session is being recorded. We record all of these sessions. And so for some reason, if you got to bump out early or you miss a week, that's okay. But for those of you that are here live, you're going to get the information first. I've got a lot of case studies, live case studies I want to share with you. Tonight, we're going to talk about a pattern that has worked, I believe it's 13 or 14 out of the last 18 years. And we're going to be dialing up and getting ready for that pattern tonight. So we're going to get into some trades around that particular pattern. I've got contrarian patterns to show you over the next 4 weeks. I've got seasonal patterns to show you over the next 4 weeks. And then I've got a bonus webinar. I'm actually going to put 2 bonus webinars out here. So this was originally a 3-week program that became a 4-week program that's going to become a 5-week program because I want to do something with cryptocurrency. There's a big change that's happening in the cryptocurrency markets. Most of you do not know what it is. But I have been following it quite intensely, especially for the last couple of years, but last seven years, in fact. There is a big change going on. I want to talk about that change. I want to show you how you can make the most of the opportunities that are coming in cryptocurrencies too. So that's good. I'm going to do that sometime in March. All right. So don't worry, you're going to get that extra bonus, but this is going to become a 5-week series. So it's recorded. Any questions you want to ask them in the Q&A box, and we'll get to as many as we can. There's a lot of people here tonight. I do this only a couple times a year for the entire group, that group of Optionetics students that we have. Thank you all again for hanging out with us and being with us for so long. I mean, some of you have been here as an Optionetics student as long as I've been an instructor, and that takes us all the way back into the mid-90s. That's how long it goes. Disclaimer you see on the screen, I'll just quickly tell you right now, you can pause this on the recording if you want to read it word by word. A couple things I want to point out. Stock and options trading has large potential rewards, but also large potential risk. The other thing I want to mention is that myself, Jay, and anyone associated with Optionetics, Tom's Trading Room, etc., we are here to educate you. All right? We're not investment advisors. We do not give personalized investment advice. All right? Everything I'm going to talk about is in US dollars tonight. And, for those of you that are new or coming back, you kind of know my drill. I've been doing this longer than I haven't. Optionetics has been around since the mid-90s. It started on a bar napkin across the street from the American Stock Exchange where I once worked. I've authored several books in various parts of the markets. I've been on TV. A lot less now than I have been because now when I do television, I do it streaming from my office. I don't drive to a television station. I just don't find that a good use of my time. And some of those people that go in to do, to drive an hour to spend 60 seconds on one of the financial networks, apparently they got, they find that's a better use of their time. I don't. am also the founder and editor of TomGentile.com, Tom'sTradingRoom.com, TomOptionsTools.com, as well as Optionetics. The refounder is what I like to call myself with Optionetics. With me tonight is Jay Harris, who is also an Optionetics alumni in so much that he was like our right-hand guy and has been with me ever since, for those of you that are just finding us again. Jay, good evening. Glad to have you here with us again.
Oh, my honor, man. I always appreciate being your wingman. Love it.
Hey, we appreciate you, buddy. So welcome back, students. I got to tell you, what we've done is, other than our lifetime reattendance, which we offer online, we have upgraded Platinum. For those of you that are wondering, what happened to Optionetics Platinum? It's now been migrated into Tom'sOptionTools.com. All right, you got to check it out, because if you liked Platinum, you're going to love this. There's just so much more that we offer. I also offer premium education, all right, through what we call our mastery programs. And we'll spend some time at the end of the month discussing mastery programs. Right now, what I want to really get into is our Trading Essentials webinar series. From 8 to 9, we're going to do it every Wednesday here in the month of February. Recordings are made available on any handouts. And I got a handout for you if you want to click on it and download it now. It's in the handout section. We'll be talking about that a little bit later in the hour. All right, so our webinar agenda. Tonight, I'm going to talk about calls, puts, trading the 5-month energy pattern, and also stock selection, which I'm going to cover first. Next week, we'll cover spread trading and trading darknet, which is our contrarian strategy. Week 3, we'll get into how to make your own and trade your own money calendar. And then week 4 is going to be a bonus week. We're going to talk about credit spreads and the layered credit spread strategy. So that's our coverage for the month, and I will add the bonus week on sometime during the month once I get an idea on when I want to actually teach it to you. Mike Wade, who is an Optionetics student, and Optionetics instructor, and now a Tom's Trading Room instructor, he had a really great quote that I just had to steal from him from a recent seminar. And he said, Benjamin Franklin said this: an investment in knowledge pays off the best interest. All right, or investment in knowledge pays the best interest. I can't agree with him more. And I want to show you something where someone who didn't have knowledge a couple of months ago that has knowledge, a family member of mine, and has actually done quite well. So my brother-in-law, Carl, he has traded off and on, but never really used a rules-based trading system. So we met at a Panera Bread company about a month ago. And he said, what's the easiest? Give me an idea of a brokerage account. And I said, well, here's one my son told me to open up with, which was Robinhood. Now, I am endorsing no brokers whatsoever. Right? You do your own homework with brokers. I have several different brokerage accounts, and that was just one that actually has the least amount of money in it. And so I put $3,000 in it and have been trading it for the last. I've actually been trading it now almost 6 months, and I've got 48% return on that account, right? Now, my brother-in-law, Carl, opened up an account just last month with $2,000 in it. Here is his account as of today. I asked him to text me from his phone. Obviously, we all know he uses Verizon, and this was right after lunch. And he had 92% left on his battery life. How do you do that? My battery life is almost dead by the time we get past lunch. So anyway, he started a few weeks ago, $2,000 account. He's been taking, now he's learned option strategies and learning specific strategies that he thinks tailors to him. And he's been shadowing me. So we've been taking like 2 or 3 trades a week. His trading costs, I asked him these questions today at lunch. I said, what's the most you spend on a trade? He goes, they're $500, but mostly less. I said, all right, what's your trading look like right now? 5 closed winners. He's got 4. He said 4 small losers. He took them off if they dropped more than $100 and went $100 against them. He has 2 open trades to date. He's got a winner and a loser right now, but this is the most important part of the whole thing. 35%, 35.95% return as of today when the market was down some 300 points. So what in the world is he doing? Well, we're going to get into option strategies. We're going to get into it. I'll tell you what he's doing. He's pattern trading. That's what I want to teach you over the next 4 weeks. Pattern trading. He's doing the cheapest options and cheapest pattern trading he can do. And so we're going to talk about that over the next 4 weeks. But I wanted to start off with this to just give you guys kind of an idea, because I've heard it before. Oh, well, you got a big account. Listen, you can do this in any size account, and you can do it better now than you ever could, because commissions have gone way down. The other thing too is that you've got slippage, which has also gone way down. The bid-ask spreads on a lot of things have gotten so tight, especially in ETFs too. But again, an investment in knowledge pays the best interest. I can tell you, my brother-in-law, Carl, he can confirm that. I mean, he can't wait till we get together and talk about what the next trades that we're looking at doing. So the way we start out is this. There are thousands and thousands of stocks out there in the market. Where are the best tradable stocks found? They're found in what I call 3 areas. Market liquidity, that's number 1. All right, stock mobility, and it has to be short-term optionable. What that means is that I need to see a lot of liquidity. I need to see a lot of players. I want to be a small fish in a big pond. And number 2, I want to make sure whatever I'm buying, especially if I'm buying calls or buying puts, has the ability to move, or at least has the perception of moving in the future. And then finally, it's got to be short-term optionable. So where do you find market liquidity? I find it at cboe.com or cboe.org. All right. I'm looking for something particular. I call it the penny pilot list. It's a downloadable list of stocks that have options, bids, and offers inside the 5-cent spread. If you have done this before, you should do it again. They're constantly changing these. I update my list about once every quarter. All right. You can Google penny pilot program, and it'll bring you up. The very first thing you're looking at is the CBOE hybrid penny pilot program. If you click on this, it'll open up this window, and you'll see right down here, and this is just a snippet of it. You'll see click here for a CSV file of penny pilot classes. You click on that, it'll drop down, it'll download in whatever spreadsheet you're using, whether it's Excel or numbers or whatever. It'll download that file, and it'll download it by company, stock, symbol, and you can get an idea of the ones that I look at. All right. Now, what I actually do is I put them into Tom's option tools, and I create a list called penny pilot stocks. And therefore, I'm able to just do whatever searches I want on those. And now I'm only looking at roughly about 325 stocks that fall under that program. All right. Actually, it's a little more than that. There's a little over 400, but I actually take it down one step more. And that's because what I do is I incorporate weeklies, the penny pilot options and the weeklies into one group. So that brings me down to about 325. All right. That's what I call the big list. The big list is at 4. Then I actually put in about 75% of those have weeklies. And then that drops the list down to about 325. So any of you that ever wanted to know what my stock list looks like, go and Google pennypilotprogram.com. You start from there. That's where I want to be. All right. Big mantra that we use here with Optionetics and Tom's Trading Room is spot the opportunity, create the low risk trade, and then plan, execute, and manage the trade. And so tonight it's all about energy opportunities. We're also going to talk about call and put options, and then we'll do a little bit of case studies. I've got one set up for you, and then I've got 3 or 4 more depending on our time that we'll look at, and we'll do them together, and we'll just look and see what kind of risk and reward we're looking at in, I think, 3 or 4 different stocks. So we'll take a look at those. All right. So let's talk about the energy cycle. We'll talk about spotting the opportunity before we even get into options. There is an energy cycle that I look at. Here it is, 13 of the last 16 years. This has worked. The price of oil is typically weaker between July and February and stronger between February and July. Now, the weaker part is like flipping a coin. The stronger part happened 13 of the last 16 years. So we're in that mid 70, high 70 percentile. That's the one I want to go with. All right. And typically the pattern runs up an average of about 10 to 15%. Now, the more that something moves, prior to that pattern, the more likely it's going to move a lot in the pattern. So if you look at the price of oil, you know what? This is probably where I need to go to some tools. So let's go over to Tom's option tools. Let me go to charts. I'm actually going to bring up USO. We look at USO every week. All right, I'm looking at least once a week. Nope, not CUSO, USO. All right, so here comes USO. Take a look at this. Now, this is a 60-day chart of USO. It doesn't really show me what I want to know. What I really want to see is about 120 days. And when I update that, then you're going to see what I'm talking about. Oil was at near $80 a barrel back over here on October 3rd. From October 3rd all the way down to about Christmas time, we saw a drop in oil from $85 or $80 a barrel all the way down to the low 40s before popping. And now we're sitting around $52 a barrel as of where we are now. This is USO. So think of USO as the ETF for crude oil. It traded up as high as 16 and then dropped all the way down to 9.25 before now settling out around 11. Okay, so as you can see, these are big moves. I mean, think about this, 16 to 9-ish. We're talking about a 40% drop in the price of crude oil. So should we expect maybe a 20% rise off the bottom? Yeah, and maybe, you know, I think that we have the chance to get to say somewhere around 13. All right, but we could find assets in that move from 11 to 13 that could double in value in terms of their jump up as we go into the energy pattern that we're looking at. All right, so for those of you that just got here, you might want to download tonight. I've got a multiple page energy report. So if you download that energy report there, it's in the handout section, then you'll get a nice long read, part of your homework assignment tonight. And I'll get into that later. But get an idea here. We're looking for a pop, a longer term pop in energy and oil stocks. All right, so we'll get to that in a moment. So the thing we need to ask ourselves is, you know, how do we trade this? So the energy trade, a typical trader's plan that actually knows this, may just say, oh, I'm going to buy some oil or energy stocks or ETFs, and I'm going to hold them until mid-July. That cost of ownership is going to vary depending on what you buy, but it's going to, I mean, even 100 shares is going to cost you thousands of dollars. My action plan, let's rent the stock. Let's rent the ETF. Let's do that for a cost of $500 or less, and that gives us lower cost, lower risk, and higher return on investment. Now that brings me into what? Options. Now, why do we trade options? Number one, we have control or leverage. We're able to control a large block of stock for a much smaller price. We have protection in the event that if all hell breaks loose and the stock goes against us, that we have a certain cap on how much we can lose. And of course, we can pay for that protection by, we're going to get into it later, spreading options. All right, we can actually offset options. So that's just a small speck of what we can do and why we trade options. So we'll talk about calls first. Calls give us the right to buy. That's pretty much it. The right to buy. To buy what? A specified stock at a specified price for a specified amount of time. All right. If we break into it, let's talk about XLE for a moment. All right. So let's get to XLE. So XLE is the energy ETF. That's the Select Spider ETF, which was at 78, dropped all the way down to 54, and has already started to make a rise. And we're looking at this thing, the next area on the horizon, somewhere around 70, which is not too far from where it is right now. Right? By the way, did I mention this pattern actually starts mid-February? So that's in another week from today. It actually starts next Friday. So we don't have to jump on the gun and get ready for this, but I want to start showing you this now so that you can be prepared for this particular 5-month pattern, mid-February to mid-July. All right. So this is XLE. Now, XLE is around 63. So now let's start asking questions for those of us that need a quick refresher on options. How many options can I buy at $63 a share? Well, that's called your contract size. Can I buy XLE options at different prices other than 63? Yes, they're called strike prices. How much time do I have on my option? That's called your expiration. Let's get into each of them very quickly. Option details, the contract size is one contract for every 100 shares. That's in the United States and most countries. There may be a few out there that have 1 equals 1,000 or again, one contract would equal 1,000 shares, but these are stocks that are relatively much cheaper, which is why they need that kind of leverage for people to trade options in certain countries. All right. Next detail was the strike price. Remember, the strike price is the price that is agreed upon in the option contract. In this case, we're going to look at 63. The buyer has the right to and can exercise that option contract. All right. Expiration dates. An expiration date is how long you intend on having that option. Now, expiration dates are all over the place these days. We have the third Friday of each month. That's the first one I ever learned about. Then we had weeklies come in. All right, weeklies were something that it happened every Friday. These are on like I said, about maybe 325 optionable stocks have weeklies. More recently, we've started having Monday and Wednesday options. So there are some assets that have expirations on Monday, Wednesday, and Friday. It's crazy. And these are typically the larger ETFs, all right, like SPY, DIA, the diamonds, the spiders, the Qs. They all have Monday, Wednesday, Friday options. Now, there are other options out there, end of month options. Those are options that expire on the last trading day of the month. There are quarterlies. Those are options that expire at the end of the quarter. And there are leaps. And a leap option is a long-term equity anticipation, or what I like to call just a long-term option. Those are any options that have more than 9 months to expiration. So which are best? That answer is kind of double sorted. What I mean by that is that if you're a short-term option trader, weeklies might make sense for you. All right. If you are a medium-term trader, then you might be looking at the third Friday of the month options. If you're a long-term trader, you could be looking out 6 months, 9 months, even leap options. All right. But let me tell you which ones are not best. Let's just go with that. I typically don't trade Monday and Wednesday options. I haven't gotten used to it yet. I do not trade end of month options. Those are going to be the least liquid of the bunch. I'll only trade leaps once a year, and that is usually with the dogs of the Dow. Quarterlies, it all depends on liquidity, but those aren't even that great either. My favorite option to trade after all this stuff comes around is still that third Friday of the month. It is the most liquid option of all of them on nearly every single asset. That's what I believe is the best. The definitions that we have with options are in the money, out of the money, at the money. And you'll hear me talk about this from time to time, where short-term options, I like in the money options if I'm going to be a buyer. If we're medium term, I'll go with at the money. If we're long term, I might go with out of the money if I expect the stock is going to outpace that premium in that option. All right. But in the money just basically are real money options. Out of the money and at the money options don't have real value. They just have time value. All right. So the next thing I want you to keep in mind, and we're going to talk about this week by week and really look at it in graphical format, is volatility. Volatility is just basically the speed of the stock relative to its time. But there are two types of volatility we use. We talk about statistical volatility. That is stock movement, past stock movement. Implied volatility is present option pricing on future stock movement. All right. That's one that I look at a lot as an option trader. It helps me determine, if do I believe we're going into a volatility rise or a volatility crush? And that helps me determine what option strategy to use. Now, let's get back to our case study and let's put that thing together as a real case study. So today, XLE traded right around the $63 mark. Right, and as I'm looking at it, looks like a big V. That's kind of what the overall market did. We dropped down in December, and we came right back out of it in January. And here we sit, February, the first week of February, and now the market's now, I think it's done its initial V move down, or V move down and then up. Now I think we're in the pause, but I also believe that I'm expecting we're going to see. We're going to see some volatility for sure, but I do expect we're going to see the markets climb out if any kind of good information does come out of the markets. Everyone's already pushing more and more bad news into the market. So any bit of good news we have, that's what we're getting these bump ups from. So remember, spot the opportunity. That's number one. Create the low risk trade. That's number two. The 63 calls with a June expiration on them, which is just a couple weeks before July. And I'm okay with June. I looked at September's also. September's maybe a little bit far out, but the June options are trading for $2.96, just below $3. The bid is $2.92. The offer is $2.99. So let's go ahead and call that $3. So that's buying that one call option will cost me $300. All right. Now, if all I thought this stock was going to do between now and June was go up $2, I wouldn't do this, because I don't want to pay for something $3 for something that could only be worth $2, 5-6 months down the road. But because we have a target price of 70 on this, this looks good. All right. Remember, spot the opportunity, create the low risk trade, and then think about, when you're creating that low risk trade, where is the stock going to be based on your back testing, based on your system, the strategy you're using. All right. It's kind of like walking into a mall. I walk into a mall, my wife walks into a mall. She's looking left, looking right, looking up, looking down. I'm looking for the directory. I want to go to the directory because I need to see where am I and what's the fastest way to get to the Apple store? What's the fastest way to get to the Tesla dealership? That's pretty much the only two places I go. All right. And so I want you to think of that too. Here's where we are, 63. Where are we going? 70. What's a 63 call going to be worth if we get to 70? And that's where we go into what I call a side-by-side comparison. So if I've got long 100 shares of XLE at 63, it's going to cost me $6,300. That's my risk. That's my break even. If we get to 70, I make 7 points. I have a 7-point open position profit at that point, or $700 on $6,300 risk. I basically have an 11% return on investment at that time. If I'm long the XLE June 63 call, and let's say I paid $3 for it, that's $300 cost, that's $300 risk. Now, what I'm going to do is I'm going to take 63 and add 3 to it. That's going to give me my break even at expiration of 66. If we get to 70, then my 63 calls are going to be worth $7. If I paid 3, 7 minus 3 is 4. That's my profit. $400 profit on $300 risk is 125%. And that's the big takeaway I want to show you as we're looking at this right now. So, what's a risk graph look like? A risk graph is a picture view of what my risk and my reward look like on anything. In this case, this is a risk graph of a call option. Up here, we have what's called unlimited reward. Down here, we have limited risk no matter how far it goes, right? So that's what I look at when I'm creating a risk graph. Now, let's look at this in details. I actually cut this out of a Charles Schwab transaction. So I wanted to show you what this looks like. So buying the XLE, all right? Again, looking at what? The 63 call, June 21st, 2019. Buy to open means I'm opening a position. All right, one contract is going to cost me $300 if I put a limit price of 3 or better. Now, at the time I did this, it was 296 by 305, so 3 was right in the middle. So if I could get this at 3, then I would have that in as 3. Now, this area timing says good till cancel, which means if I don't get filled today, the order is in effect until I cancel it, or in this case, it's good for 60 calendar days. So that'll stay out there for 60 days unless I cancel it or it fills. Now, when I put this in, let's say it does fill. What do I need to do? What is the next thing I need to do when this fills? I need to create a sell ticket. And I want to go in here and I want to change this around. I want to make sure this says, if I'm filled, sell to close 1. And then my limit price is going to be 6. So if I'm buying it for 3, I sell it for 6, that's a double. All right. I don't need to wait till XLE gets to 70. If it gets to 69, it gets to 68. I might have a double on my hands. I'll take the double. If I buy more than one contract, I'll sell half of them. Let's say I buy 2 contracts. I'll sell one of them just to take my money back, take my original investment back, and then let the rest of it ride out until I feel like it has reached its target. So that's one way of doing it. Trading puts, Very similar. All right. Long puts got the same characteristics of long calls, but in down markets. They have the same 1 to 100 contract size. They have the same number of strike prices, expiration dates as calls, but puts increase in value as a stock price decreases. All right. I had puts. Oh, Jay, by the way, cue me up some questions. If there are any folks that have questions that you feel like that we need to ask and answer, please bring them up. But as you're getting ready and you're scrolling through and looking at it, because I know there's a lot of stuff out there, we won't be able to get to all of them, guys. I apologize. But look at puts, for instance. I had puts a couple days ago on Activision, all right, ATVI. ATVI, boom, went down 5% or so. And so that ended up being a triple for me. I got puts right now on MGM, all right? And MGM is kind of ticking down, and as it's ticking down, my long puts are ticking up. Jay, questions?
Got a couple real quick. Rebecca's asking what's more important when it comes to looking at liquidity, volume or open interest?
Yeah. Very good. Very good. It's actually neither. Okay. Let me show you what's the most important. Let's go look at an option chain right now. I got an option chain right here on XLE. In fact, I have it. It's the one from earlier today. If you look here, it's the difference between the bid and the ask. The tighter those are, the better I like them. Take a look through 292 by 299. All right. So that is, you're looking at a 7-cent bid ask spread. That's fantastic. Let me show you another one real quick. They get better too. If you look at Apple, right? So I like Apple to the upside right now for a number of reasons. But take a look at its bid ask. This is the ones that expire here in one day. Let's go to the March 15s. So as you can see here, I have a whole group that I can look at. I'm going to look at 10% up, 10% down. But what I'm going to look at is just right in the middle. The 170 calls are 520 by 530. The 175 calls are 292 by 299. The same 7 cents. All right. Still, that's very, very liquid. Look at Facebook. So Facebook, not the most favored stock out there, but I got to tell you, the liquidity looks good on this one. 62 by 67. That's the one with 1 day to expiration. Let's go look at that. Let's look at next week's Feb 15. All right. Take a look at that one. 8 days to expiration. 165 calls, 350 by 365, 167 halves, 219 by 225. These are nice. They are nice and tight. They are tight. If you want to see something that's really tight, take a look at this. SPY. S&P 500 ETF, one of the most liquid traded optionable ETFs out there. Here's the Feb 15s. Look at all these strikes. Ton of them. 270, 231 by 235, that's 4 cents. Look at this 270 halves, 201 by 205, 4 cents. 271s, 174 by 177, 3 cents. These are very, very liquid. There's a lot of ETFs out there that are incredibly liquid. And so to answer the question once again, it's about the bid-ask spread. To me, that is more important than volume or open interest. What else you got, Jay?
Did you want to get into how you came up with that $70 price target?
Yeah, you go right back to that 10 to 15% jump that we talked about. And what we're looking at is we're looking at using that statistic and taking 63 and 70 is like maybe 11.5% above 63. So, I mean, it sits right in the wheelhouse there, and that's how we came up with that, looking at the average percentage move year after year in this particular piece. And let me mention one more time, depending on who jumped in, if you're late here, welcome. In the handout section, you will find, and I'm just going to click on it right now and show you what it looks like, the Oil and Opportunity Energy Report. This is a 27-page report that I've put together for you for 2019. And it actually talks about not only my intention of the report, but the 5-month seasonal bullish pattern, the 3 categories with a technical look at oil, and our case studies on Exxon and XLE. So we got a couple of them there that we want to share with you. I want to actually create a few more with you tonight. So, Jay, are we ready to move forward?
I believe we are ready to move forward. Yeah, thank you.
All right, awesome. So, I mean, so far what we're doing, most of you in here probably understand, you understand options. You should, because you're all long-term Optionetics students. And maybe the only thing that you might find new is some of the ways that I've been looking at patterns over the last several years, because some of us haven't reconnected in several years. I get that. All right. And so, it's kind of my job to help bridge that gap and reconnect us again. So now what I want to do is we're going to look at some trades together. I have not prepped these at all, so they're not there. I just want to let you know that we're going to go and we're going to look at a couple of different oil stocks. And I'm going to show you what they did last year, and we're going to look at them where they are right now. We're going to use that 10 to 15% buffer, and we're going to see if we can find just simply right now call options that might make sense. And then we'll both kind of come up with what we feel are the best ones to take a look at there. So let's go ahead and do that right now. So let's pop over to the tools. Oh, you know what? I've got some charts here to show you first. So we'll spot the opportunity, create that low risk trade, and we'll plan, execute, and manage. Here is Exxon. Now, this is last year between mid-February and this is actually right into May, but we go into mid-July, and it puts us right over here around, we'll take it from, again, 76 to about 84. All right, so 76, 10% is 760. All right, so if we were to take 10%, that puts us right up into the mid-80s area. So we could do that again with Exxon. So let's go ahead and jump to a stock chart, and let's look at Exxon today, symbol XOM. Here we go, XOM. So XOM was in the high 80s, dropped down to the high 60s, trading right around the mid 70s. And you know what? I'm looking at mid 70s. I would think that low 80s would be a good area to target. And at 82, we have resistance. And at 84, we have resistance. So right in the 82, 84 area, let's call it 83. So what we're going to do is now it's just very simple. We go to the stock and options tables. We type in XOM. And I'm going to update first the stock symbol, and then what we want to do is we're going to go out to June. Okay, there's July 19th. There's a July option, mid-July, right there on the money. So let's click update, and let's just see what we've got. Actually, what I want to do is I want to go out 15% higher. So 15% will give me an idea. Okay, so that takes us to 85. If I am looking at the 75 calls right now, they're trading for $3. Now, these are at the money to slightly out of the money calls. But if I expect Exxon to go to 83, here's my question to you. All right, let's stop asking me questions for a second. Let me ask you a question. If I buy this $75 call and I pay $3 for it, we're going to make it real simple. And the stock goes to 83. What's the 75 call worth? I wish I had the theme from Jeopardy right now. That would work out really well. If I paid $3 for this July 75 call, which I'm going to go in and I'm going to just show you what it looks like on the risk graph by buying one.
Hey, if I sing that, Tom, I'm going to have to pay a royalty, so I might have to back off on
that. What kind of answers are you getting? Are we getting the right answer? So 75, I pay $3 for it. Jay, what are you saying?
It's coming in at 8.
And that 8 is correct because you take 83 minus 75, and that is 8. If I'm going to pay $3 for something that I believe is going to be worth 8 based on all my back testing and all my strategies, is that a good trade? And the answer is yes, it's a good trade. It's more than a double. All right. Remember, to get a double on Exxon, it's got to go to 150. All we need to do is go to double, we just got to get it to go to 81 if we pay $3 for it. If we pay $3.15, okay, yeah, we got to let it go to 81.30, all right? But I'm trying to keep this easy so that everybody understands it. There's your risk graph, all right? Here's where we are. Had earnings that were better than expected. Here's the most we can lose, no matter how low it goes. And then anywhere on the screen, we get right here. I'm just going to leave my mouse here, and there's the pop-up. $81.84, we have a $384.71 profit. Up here in the red zone, we get up here to around almost $85. We have $700 in profit. All right. So that's how we could evaluate that. So that's Exxon. Let's take a look at another one. This is Schlumberger. Schlumberger. I think I said that right. Again, this is one that actually moved a little higher, but you know, I mean, we were mid-February to around that mid-July was really only about a 5-point move. So if we look here and we type in SLB, so let's go back to the stock chart and let's look at SLB. And we have to think about the fact that it only moved, it didn't move much at all. The most this thing might be able to go is to 50. Let's say if it's at 50 and we're at 40, 43, 46. I mean, maybe 48, you know, if we're going to look for a 10% move. So Schlumberger, SLB, again, what would I do? I first would go in, I look at the strategy, I look at spotting the opportunity. Now I'm going to go 10% on this one because I think that's the most that it could go. And then I'm going to go out and say, okay, 10% between now and there's June. There's no July. There is an August. There's a June and an August. I think, you know what? I'll take the August just to be safe. Here's the August. And this is 10%, so 47.5. So if I buy, let's call it the 45 call for $2.63. What's it going to be worth if we get the 47.5? It's only going to be worth $2.50. So that is not a good trade. What about the 42 halves? If I buy that for $3.83, well, the most that can become at 47.5 is $5. So I mean that's better, but we're only talking about $1.17 if we get to 47.5 by expiration. So Schlumberger, I still like Exxon better than Schlumberger. Let's take a look at one more. Pop on over. EOG Resources, 100 to 125. Let's go take a look at EOG and see where it is right now. EOG. All right, so EOG up. You know what? We needed 15% on that guy. That's going to be a top tier. And we also got to take it all the way out to July. There's July. So let's look at the July options. Here we go. Okay, so it's trading at 92.99 right now. You know what? We need to look at EOG on the chart, see where it is right now, where it's been really. All right, it's been to 130. It's been down as low as below 85. It's come back up. It's actually pulled back a bit. This is interesting. Does have earnings coming out in 19 days. Last earnings were up. Maybe the earnings that are going to maybe propel it back in that direction. I don't need to worry about earnings when I'm taking a 5-month position. All right. If this were a trade that was going out to, if I were using March options, I'd be a little more nervous about earnings. The fact that I'm looking at July, August, you know, that we got a couple of earnings to go through there. It's not going to, the gamma is not going to be as high out there. All right. And the volatility won't be either. So back to EOG. So we're looking at July. And if I were looking at the 95 calls, all right, and I was looking at this to go out to 105, this is a 95 call, $7.43. First of all, that's over $5. If I want to stay in my $5 minimum, I got to scratch out the 95. I got to scratch out the 97.5. I might even have to scratch out the 100. But more importantly, let's say we could get that 100 for $5. At 105, it's still only worth $5 at expiration. So we're going to look at this one next week because we could look at this as a spreading opportunity. This might make the most sense to spread. How about one more? Let's just look at one more. HollyFrontier. Wow. Look at that move. 45 up to 80. That's a big move. So HollyFrontier, HFC. So let's go look at the chart. HFC. And the chart is going to show me HollyFrontier going from 76 all the way down to 46 and back up to around 54. I think HollyFrontier, if we look at target prices, I'd say 62. And where are we right now? 54. So, I mean, 62 puts it just above 15%. So let's go to the option chains. Let's type in HFC, and it says 15%. And we have to update it first. All right, now that we've updated it, let's go look for okay, June or September. Let's use the June. It's closest to July. Going to be a little bit quicker. All right, so our 15% is at 54, puts us at 60. So if I were to buy the 55 call for $4.50, it's only potentially only going to be worth $5 at 60. So did everybody? I hope everybody got something here. This was a lesson in taking your opportunity and trying to find that acceptable risk reward trade. And so far, we only found it. We found it in XLE, but we also only found it in Exxon. All right, for this week. We're going to revisit these again next week when I start talking about spreads. All right. Now, any of you that want to do some homework, look at that energy report, because guess what else I have in here? I have spreads. I actually even have butterflies in here too, if you want to really get technical. Those are all the way down. You know, if those of you in here are like me and you read books, you read the first chapter and the last chapter, and then the rest of the stuff in the middle you just get to when you can. You know, when I read Harry Potter, I don't want to go through all the BS in the middle. I want to know if he lives or dies. Anyway, here's your case studies, page 20 through 26, and you'll see the long call debit spread and butterfly spreads. But we talked about so much more tonight in terms of looking at the oil and energy opportunities. So let's get back and see if there is any more questions before I give you my homework assignment for you tonight, as well as what we're going to cover next week. And I've got some really special announcements that I'm going to be letting you know about in just a few minutes as well. Jay.
Yes, sir. Yeah, impeccable timing, because somebody was just asking about multiple leg or multi-leg options, and you talked about the spreads and the butterflies. I told them those are coming in the upcoming weeks. You're going to get into the spreads.
But also, you know, let me talk about this right now. There's no reason why, if you're getting into a trade and it's moving higher and higher, that you can't just roll out of that call. Let's say you're in. Let's bring up. This was not really what I'm looking for. How about Apple? Apple's a real good example. You know, I was with the family the holiday week when we had this low that happened. This actually happened just after January 1st. All right, where was I? At Disney. I was at Disney. Hey, listen, you know what? I know a lot of people love Disney. I got to tell you, Disney's great. I can't stand staying in a line for 4 hours for one ride, and that's what we did. That Avatar ride, 4 hours. I got there at 1 o'clock. We were getting on the ride at 5. 4 hours. But why did I bring up Disney? Oh, I have no idea why I brought Disney up.
Are you going to bring up the chart on it?
No, I don't want to bring up the chart on it. I think I brought it up. Oh, I know why I brought it up. Because my brother-in-law and I were in that line, and we were actually looking at opportunities that day. And Apple was one that came up. And I just want to show it to you for a moment, so that if you see like Apple's in the 140s and it pops up to around that double high that got us up close to 160. That's an idea where if you're holding the January options, you know, you're coming up to January expiration, close that out, roll out to the Februaries if it still hasn't hit your target. And here we are, Apple's kind of climbed up again, and now we're back up in the 170s. So those rollouts can be very lucrative if you believe the target hasn't hit yet, and yet you're running out of time and you've made some money. You can bank the money you have, roll up to the new strike, and get back in and just rinse and repeat. So that's something I just wanted to add. Any more questions, Jay?
Yeah, this one's more of a. I answered it as the reason being probability. One student was asking, you used to go for a 3 or 4 to 1 reward to risk. Why the 2 for 1? And I answered it based on probability. If you have anything more to add to that.
Yeah, I will. I typically do more than one contract. And however many contracts I do, I get out of half of them when they double in value. Then I go for the 3 and 400 percenters. And the 3 and 400 percenters even make more sense when you're doing spreads and when you're doing combination trades, where you don't need a whole big move in the stock price to get many more than a 2 to 1 multiple. When you're doing simple call options and put options, For me, I like getting out of at least half the position when it doubles in value. I put them in as limit orders, so that they're already there. I thought MGM was going to hit on me today, but it didn't. Maybe it'll hit on me tomorrow morning. The way the markets are down 10 points tonight, that may very well happen for me. So,
and then Tom, real quick, just iterate again where the handout is. We're getting multiple questions on that. I'm telling everybody from the control panel.
So here I'm going to make it very simple for everybody. Number one, the handout is actually if you look inside your GoToWebinar control panel, you'll see an area that says handouts, and you'll say Tom's 2019 Energy Report.pdf. You can click on that and it'll bring it up for you. The other thing I'm going to tell you is that I will email you that over tonight along with the recording of the webinar. I'll email you the link so you can download the energy report from the email that I'll send you tonight. All right, guys. Also, if you're new and you haven't checked out tomsoptiontools.com, take a look at it. 7-day free trial. We're actually going to be eliminating the free trial at the end of this month. So if you I've had it up there, guys, now for probably 2 years, and so we are making some pretty cool changes. But one of the things we are doing is we are eliminating the free trial. Take advantage of it if you haven't. If you sign up and you just don't like it, then just cancel before your first month's payment comes in. I want to let you know something else that we got going on too. So we are moving forward and developing apps. We are developing apps for both the Android operating system and the iOS operating system. I am going to show all of you our very first app next week. You're going to see our very first app next week, based on a very cool strategy that we've been working on, and as we've been trading it on and off now for many years. So I can't wait to show you guys that. That's based on our contrarian trading strategy, Darknet. So next week, I would like you to read the report that I've got for you. Read through that, because it's going to be a good read, because guess what? It has a happy ending, and that happy ending is a repeated rules-based trading strategy that's worked many more times than not over time. Check that out. I want you to review the trades and the case studies we came up with today. Next week, we're going to review the homework. We're going to talk about vertical debit spreads. Those are bull call spreads and bear put spreads. And we're going to talk about trading the darknet contrarian strategy with live case studies. So please tune in for that. Jay, any final thoughts?
Yeah, some people are asking again for the penny pilot list URL. And I'm just encouraging them, Tom, you're going to send the email out with a link to the recording. So when you show that, they're going to be able to see that and get that there.
Yep, guys, it'll be out within 1 to 2 hours. All right? We don't screw around here. Once we're done with the live event, our guys get together, work, and we put that thing out to you ASAP. You don't have to wait for it tomorrow. It'll be in your inbox within the next hour or two. All right? Thank you, everyone. Good night. I look forward to seeing you next week. We're going to obviously review this week's trades. We got more trades coming to you next week. Till then, have a great evening, and I'll see you soon. Bye now.